Jobless claims a little bit earlier this morning, upside surprise. That was about 37 minutes ago. That came in at 228. The estimate was 200K, and a big upward revision to the previous number as well. Payrolls come out tomorrow morning. Kailey Leinz, payrolls have come in just a little bit. We were looking for 240. We're now looking for 235.
Yeah, that's right, which arguably relative to history is still fairly robust job growth, but that would be a slowing in the pace of non-farm payrolls additions from the month of February. So it's really going to be about whether or not tomorrow's print confirms what the data we've gotten over the last 24, 48 hours suggests, which is weakness, the lagged effect of monetary policy tightening starting to show up in the economy. Maybe you see that in this initial jobless claims print, which, as you've suggested this morning, John, is the wrong kind of upside surprise, both in the weekly print and the prior revision, which, as you suggested, did move significantly upward, though part of that is due to updated seasonal factors. Then for tomorrow's jobs report, 235,000 is what we're looking for on payrolls. But the other factor that is going to be incredibly important to the Federal Reserve is average hourly earnings. We are actually expecting a tick up in the month-on-month growth to 0.3%, though year-on-year basis, we are expecting a cool down from the pace of February to just 4.3%. So the question really is, does this confirm what the market believes, which is that this Federal Reserve is going to have to start turning around and cutting by the end of this year? You see that evident in the two-year yield once again today. Fifth day in a row, this yield has come down. That is the longest stretch since July of 2022. And at 3.77%, we are, more than 1% below Fed funds. So this monetary policy sensitive part of the curve suggesting that the Fed is wrong, this market betting it is right, and perhaps the data we're getting just fortifying that belief on the market's part, John.